Do you know why some traders always seem to catch the perfect trend while others are left behind? The answer lies in mastering the flag pattern. And once you do, you will unlock the ability to spot profitable opportunities before anyone else. So in this video, you will learn what is a flag pattern and how does it work. What is the structure of the flag pattern? The best time frame to trade a flag pattern? When should you trade the flag pattern? And how to trade the flag pattern trading strategy. So, what is a flag pattern? Right, the flag pattern is a widely recognized formation in trading. Think of it as a little breather between the strong moves in trend. This appears as a minor consolidation on the chart. So, when you spot this pattern, it is a signal that there is a good chance that price will continue moving in the direction of the existing trend. So here are the two things to look for when you identify a flag pattern. Number one, keep an eye out for a strong trending move, which is usually indicated by big candles. Number two, expect a weak pullback, which is often characterized by smaller candles. So these criteria are your go-to guide for recognizing the flag patterns on your chart. So here's an example. As you see over here, this is a strong trending move, right? Followed by this weak pullback. So this one over here is what I would consider a bullish flag pattern. Small body candles, meaning a very weak pullback. So this is also another example of a flag pattern, small body candles. And then you have this strong trending move just before this weak pullback occurs. So bearish flag is just the opposite. There is a powerful downward trend that is happening. The black lines show where the bear flag pattern appears. This looks like upward corrections or pullbacks. And the small candles suggest that these pullbacks are not very strong. So, what is the structure of the flag pattern? The flag pattern consists of two components, a flag pole and flag. The red line is the flag pole and the black channel is the flag. If you take a good look at it, it does really resembles a flag, right? So once you know what to look for, spotting the flag pattern becomes pretty easy. The flag pole is the first part of the flag pattern, and it represents what? It represents a strong trend on the market. Essentially, any big upward or downward move can turn into a flag, making it look like a flag pole. So when the flag pattern starts to take shape, you will notice a significant initial move, often called the flag pole. And then after that, there's a short consolidation period, forming what looks like a flag. So once the flag pole is in place, a proper flag pattern would start to develop. So trading within a narrow range, forming the shape of a flag. The flag part has a price action with tops and bottoms evenly placed. So this price action brings a corrective element to the chart itself. And then interestingly, the flag is slanted in the opposite direction of the initial trend impulse that created the pole. So the choice of time frames for identifying flag patterns really depends on your trading style and your goals, right? So, usually the flag pattern is frequently applied to what? Shorter time frames, like the 1 hour or the 4 hour, right? So on these shorter time frames, the flag patterns can form really quickly, creating opportunities for short-term trades. However, it is important to note that the shorter time frames comes with increased volatility. So, and that requires, right, even more frequent monitoring. So for traders with longer perspective, you can also employ the flag pattern on longer time frames as well, which is pretty common. This is because it can also offer a more reliable signal on a bigger prolonged trend. So traders use the flag pattern to not only spot short-term trading opportunities, right? For example, in the lower time frames, but also to identify potential entry and exit points for the longer term trades or to validate existing trends. So this allows us to enhance the reliability of the pattern. It is advisable to cross-verify it across what? Multiple time frames before trading the flag pattern. So now let's talk about the best time frames to trade the flag pattern. There are 2 times when you should trade the flag pattern. First up, it's a good idea to jump in when the market just kind of broke out of a consolidation. Now, let's say the market has been stuck in a range for a while, and then suddenly it breaks down. When the market breaks down, the best time for you to trade the flag pattern is what? During the first pullback. Why? When a bearish flag pattern starts to form after the breakdown, it's the perfect moment to jump in. Well, for one, traders who miss the initial move will be what? They'll be eagerly waiting for pullback. Once the market pulls back during the formation of the flag pattern, there are traders who will be looking to short the market since they missed the earlier move. So what? Their intention is to catch up with the trend. So that's why you should consider to trade the first pullback or the first flag pattern right after the market breaks out. Okay? The breakout point is where the market breaks through a resistance level. Right after this, there is a pullback, which happens close. It's pretty close to the breakout point. So this is a good opportunity to trade it, right? So when you observe that after the pullback, the market continues to move downward, and then the price doesn't fall above that breakout level, that's where placing a trade during the pullback would result in relatively good profits for you. Number 2, another good time to trade the flag pattern is when the market is in a strong trend. In a strong trending market, you will see a sequence of trending moves followed by pullbacks. Basically, it's a series of what? Ups and downs. So typically, when the market is trending strongly above the 20 moving average, these moments presents opportunity to trade the pullback, often in the form of a flag pattern. The market is showing a strong upward price movement. Within this trend, there are patterns called the bull flag patterns, which is highlighted with the black lines. So these patterns would provide excellent opportunity for trading the market in the form of a flag pattern. Say, if you have bought, say, a currency pair during any of these bull flags, you would have made profit because price constantly maintain an upward trend. Now, let's talk about how you can go about trading the flag pattern. Number 1, the entry point. When entering a flag pattern, the key is to wait for a confirmation signal, right? So this confirmation usually comes from a breakout, right? So for a bullish flag, you can consider buying the pair, buying the stock, buying whatever commodity or buying whatever currency when the price action closes a candle above the upper side of the pattern. So if it's a bearish flag, you will then sell when you observe a candle closing below the lower level of the pattern, right? This will ensure you a more reliable entry into the trade itself. Number 2, placing a stop loss. So once you have entered your flag trade, right, it is important to set up your stop loss order, right? This will allow you to protect your trade from any sudden or unexpected price movement, right? Because nothing is guaranteed. When deciding where to position your stop loss for this type of trade, there's one basic rule that you should always consider. If price reaches the opposite side of the breakout, it is important to exit the trade immediately, right? This is because there is a high chance that the pattern is false. To determine the ideal location for your stop loss, look for the most extreme swing within the flag structure. For a bullish flag, set your stop loss below the lowest bottom of the flag. If price attempts to move below that level, the trade will be closed, preventing further losses. For a bearish flag, position your stop loss above the highest top of the flag. So if price tries to move above that level, your trade will now be closed with your stop loss order, protecting you from further losses. Next, take profit. When you decide where and when to take your profit, it's essential that you consider the 2 targets discussed earlier. The choice of which to target, to pursue, is yours. But it's a good practice, right, to have your target profit and take them at each level to secure your gains and to minimize your risk. So every trader has their own management style that suits them. So let's have an example of managing a bullish flag trade. So once you open your flag trade, set your stop loss below the extreme point of the flag. Now, once price rises and completes the size of the flag, you can now consider closing 1/3 of your position to book profits. Adjust your stop loss by raising it just below the initial target level. If the price continues to increase and reaches the second target level, this is where you close another 1/3 of your position to further lock in your profits. Now, adjust your stop loss again, placing it just below your second target. For the remaining of the trade, that's where you monitor your price action carefully. If price continues to trend upwards, you can hold the last 1/3 of your trading position for as long as you want. This way, you know what's going to happen? You are progressively securing your profits while you manage your risk. So this is kind of different from your standard TP. This methodology allows you to capitalize as much as the market moves while securing profits along the way. Now that you are familiar with how to trade the flag pattern, I'm going to show you how to perform technical analysis right on this formation using the charts itself. This chart, in this case, is the USD SGD pair. You can see a clear demonstration of how to perform technical analysis for all the different trading opportunities that I'm about to cover. The position of the flag is shown using the 2 black lines, which is running parallel to each other. The best position to buy this pair is indicated where the flag breaks out above the upper level, marked as the buy with the green arrow. So this breakout not only confirms the pattern, but also creates a long trading opportunity on the chart itself. Now, the chart indicates the recommended position for placing the first stop loss order, which is simply at the lowest point of the flag. That is identified as stop loss 1. So now, if price attempts to dip below this point, this trade setup will now automatically be closed. That's where you exit the trade, preventing further losses. As you reach each target, it's important using this methodology to adjust the stop loss order upwards. This way, we are what? We are trailing. So this strategy allows you to lock in profits as price continues to rise. And that safeguards your profits in this way. And it also avoids the scenario, let's say, where your gains get wiped out in the event of a price reversal. So on this chart, you're going to notice two other stop loss order marked as stop loss 2 and stop loss 3. In addition, we measured the size of both the flag and the flagpole. So when you apply these measurements to the chart from the breakout point, that's where you can see all this positioning. It's important to observe that both targets have been successfully reached. So after hitting each target, you should adjust your stop loss accordingly. The trade ends when the price of the currency pair, in this case which is currency pair, or it could be any other vehicle out there, breaks the third stop loss order, as indicated by the red arrow pointing to the close level. Now, beyond stop loss 3, the price continue to decline. So even future attempts by the price to rise did not reach this stop loss order. So were it not for stop loss 3, you would have faced, big losses in the long term. Okay, let's sum it up. Number 1, a flag pattern is characterized by a weak pullback in an existing trend. And that is often represented by what? Small bodied candles. Number 2, when we talk about a flag pattern, think of it like the market holding up two parallel lines. So it's as if the price is contained within these lines, showing a kind of balance or temporary pause in the overall trend. Number 3, the best time to trade the flag pattern is after a breakout. The breakout acts as a confirmation of the pattern. You can also trade the flag pattern when it's showing a strong trending market. Number 4, to manage your risk, it is good practice to set a safety net. Placing a stop loss order at the lowest point of the flag pattern ensures that if the market takes an unexpected turn, you never know, you are protected from further losses. Number 5, if you see a bearish flag, it means that the market started with a downward movement, right? Then there's a correction pushing the price upwards temporarily. But don't be fooled, it carries bearish potential, signaling that the downtrend might resume. Number 6, if you spot a bullish flag, it signifies an initial upward surge, right? This is followed by a correction that takes price down briefly. So despite this dip, the overall picture suggests a bullish potential, indicating that the upward trend could continue. I've created a free 5-part training that shows you exactly how I trade. Check out the link in my bio.